This presentation covers Chapter 1, Environmental and Theoretical Structure of Financial Accounting, and then I'm going to go through 2 examples to help you with the homework. Now, what is accounting all about? Remember, that is the identification, recording, and communicating. And remember, it's only financial information, i.e., it has to have something to do with currency or we're not going to record it, about an economic entity, which is a separate unit, to inform parties. There are 3 organizations that provide the guidelines for accounting in the United States. We have the Security and Exchange Commission, we have the Financial Accounting Standards Board, and we have the American Institute of Certified Public Accountants. Now, the Financial Accounting Board is the one that sets GAAP, Generally Accepted Accounting Principles. The Security and Exchange Commission can intercede if they don't agree with something. And the American Institute of Certified Public Accountants focuses primarily on the certification of accountants and training, ongoing training. Now, in terms of the overall rules, we have one set of rules which are based on the International Accounting Standards Boards. These are various rules that govern other countries, and it is principle-based and focuses on countries where the primary users of financial statements are private investors, also countries where the primary users are tax authorities or central government planners. Accounting rules are made by other than the accounting profession, so accounting doesn't set the rules. Where in the United States, where we have the Financial Accounting Standards Board, this is rule-based and is focused on investors and creditors, and the accounting profession plays a key role in setting the generally accepted accounting standards, also known as GAAP. Now, a long time ago, they tried to bring these 2 together and have only one standard. It was concluded that it was not feasible for the U.S. to simply adopt the international standard. And the reasons were that there was a need for the U.S. to have stronger influence on the standard setting process, the higher cost to companies of converting to the international standard, and the fact that many laws regulations and private contracts reference US GAAP. Well, we like our rules. We don't like the ambiguity of the international standard. Now then we have the conceptual framework. The first level is basic objectives, which is the purpose of accounting. The second level is the quantitative characteristics and elements, accounting terminology. And the third level is recognition, measurement, and disclosure concepts. And this is the area that we focus on. Now, the first thing you need to remember is these primary underlying accounting principles and guidelines. 1, the economic entity. A company keeps its activity separate from its owners and other businesses. Going concern. Company has the ability to last long enough to fulfill objectives and commitments. One of the key is, do you have enough current assets to cover your current liabilities? Now, monetary unit. This is the assumption that money is the common denominator. We have periodicity, which means we can divide our activities into time periods, which is months, quarters, years. Full disclosure must present all information that would affect the decision of an informed user. Historical cost must record at the original cost, except for those balance sheet items that are treated at fair value, which allows you to adjust to fair value. So you may record at the initial cost, and it used to be then you couldn't change it, but under the fair value rule for some balance sheet items you can. Revenue expense recognition. Record revenue when earned and match the expense to the revenue or when consumed. Now we have a whole chapter on revenue recognition because it recently changed and became a lot more challenging. Now, cash accounting produces a measure called net operating cash flow. It is the difference between cash receipts and cash payments. This is how a lot of small businesses keep their books. This is not GAAP. Accrual accounting is required under GAAP, and we are required to record revenue when it's earned, expenses when they are incurred, regardless of the exchange of cash. So cash does not drive the journal entries. This is also known as the matching principle. Now we're going to take a look at two examples. Now, January 1st of 2022, Mike formed a computer sales and service company and he invested $90,000. Various financial transactions occurred during the month that were both cash and non-cash. So, what we're going to do is analyze the transactions and figure out what does our income statement look like on a cash or accrual basis. So, the first thing we did is we paid $6,000 in advance for 3 months rent. Now 1 month has gone by, so for cash basis we booked the whole thing, but for accrual basis we only booked 2,000. Next, we purchased 40 computers for 1,500, 6 graphic computers for 2,500, and 25 printers for 300 each, and all was for cash. So the total amount of cash paid is 82,500, which is what would appear under expenses for a cash basis. But none of this would appear on the income statement for accrual basis because we cannot record it as an expense until we sell the goods. Now the next thing is we had salaries, 12,600 and 3,000 were payable at the next month. So what that means is on a cash basis, we only have 9,600. But for accrual basis, we record the whole amount. It doesn't matter when we pay it. Next, now we're selling computers and printers, and let's see what that looks like. So we received $75,000 cash, so that would be our revenue on a cash basis. For accrual basis, it would be the total sale, which is $75,000 plus the $23,400 that was not paid. Now, cost of goods sold. This only applies to our accrual basis, would be based on the units that we sold, which is the 59,500. Now, operating expenses were 10,400 with 2,000 payable in the next month. So, for our cash, it would be 8,400. And for our accrual accounting, it would be 10,400. Now we can see the net income. And as you can see from this, on a cash basis, we had a loss of 31,500. But on an accrual basis, we had a profit of 13,900. Now we'll take a look. Now, okay, so that's what's that. Now let's take a look at the balance sheet. First, we got to figure out our cash. Now, this would be the same for whether we're doing accrual or cash accounting. We would look at all the amount that we have invested and what actually went out in cash. And so our cash balance at the end of the month is 58,500, and we can put that on our balance sheet for both the cash and accrual basis. Now we're going to look at the accrued items that we're going to have on our balance sheet under accrual basis. So first we had our $90,000 investment. Now for our owner's capital on accrual basis, it would be our $90,000 investment plus our accrued net income of 13,900. Now we paid 6,000 in advance, but we have 4,000 that applies to future months, so we would have prepaid rent of 4,000. Then we have some inventory left over based on we sold some. Then salaries, we owe 3,000 in the next year, so we've got salaries payable. And then we sold 30 computers, and we still owe the customers still owe us 23,400. So we've got an accounts receivable. And then last, for operating expenses, people still owe us $2,000 at the end of the month. So now we can do our balance sheet, and you can see we balance. Now let's take a look at another example. Okay, in this example, we had the following transactions. We had amounts billed to customer, cash collected from customer, and then we had cash disbursements. We had payments of 80, salary, advertising. Now here's the thing, we need additional information if we're going to try to figure out the income, the net income for year 2 and 3. And we get that. So in addition, the company incurred $25,000 in advertising costs in year 2, owed advertising of $5,000 from year 1, and there was no liability at the end of year 3. We need that information to figure out how much did we spend in year 3 on advertising. There was no bad debt for receivables, and rent paid in year 2 was for 2 years. So that $80,000 was for year 2 and year 3. So now let's take a look at how would you do an income statement based on this information. Now, we assume that all sales are on credit, so the amount billed in each year equals the revenue each year. The rent paid is for 2 years, so we're going to take the 80,000, divide by 2, we get 40,000 for each year. The salaries paid, salary expense, since there was no amount owed at the end of any of the years, would be like we must be paying these people cash, because we all know that something's going to be owed at year end, but not in this case. The same goes for utilities. Utilities paid and utility expense are the same, primarily because there's nothing owed. Now, advertising expense is a little trickier. Now, for year 2, it's easy because they tell you advertising expense for year 2 is $25,000. So we can do that. But now we have to figure out year 2 and the balance owed on advertising expense. So here goes. We determine advertising expense for year 3. We started with owing $5,000. We incurred an additional $25,000 and we paid $15,000. So we had a balance of $15,000 owed at the end of year 2, which is the answer to one of our questions. Now, how much did we actually spend how much did we actually consume on advertising? So we paid $35,000, so the difference is advertising expense for year 3. And that's how we come up with our net income for each year. And that's very similar to your homework problems. I hope that helps, and that concludes our lecture for Chapter 1.